Hello, everyone. This is Pratik here, and there is an important and interesting concept which I'll be discussing today. Many confusions, many doubts about this, and I hear this question again and again from the students. A simple question, simple idea here. When should you trust EBITDA less than the net income? Now, the thought process here is very simple. Let's try to understand what exactly do I mean by the word EBITDA. What is EBITDA? Now, in simple terms, EBITDA it's nothing but earnings before interest, tax, and depreciation and amortization. This is a plain vanilla definition. The earnings which any company generates before it pays out it pays out the interest, tax, or depreciation and amortization component. We are, given this training, or we are always with of the thought process that EBITDA is usually more trustworthy when you compare it specifically to net income. You know, we've taught this, we've been given this kind of an understanding always, but there are certain situations, especially there are three such scenarios where this regular convention falls apart. Three situations, and I'll tell you which are those situations, and when you should rethink about depending or flying blindly following what EBITDA is telling you. So the first situation is uh, the capital structure. Now, what is capital structure? Let's try to understand this. Capital structure is simply the proportion of debt and equity which is sitting on the books of your company. How much proportion of the overall capital of your company is funded via the debt, and how much of it is funded via the equity? That is nothing but the capital structure. Now, let's say if your company has taken a high debt, the debt level is pretty huge, thereby leading to a very high interest expense. Yeah, interest is nothing but the cost that you pay on a debt. So naturally, if your company has a huge amount of debt, the interest payment will also be high. Now, if your company is falling into this category and you're blindly looking at the EBITDA is ignoring this interest cost. Look at the definition again. It's earnings before interest, tax, and depreciation and amortization. This is something which you are ignoring when you're looking plainly at EBITDA. So definitely, any company which has a huge amount of debt, or there is a high debt component, then they will definitely, it doesn't make sense to look at EBITDA alone. There are other metrics that you need to look. The second situation, the second scenario, reinvestment requirements, or alternatively, we can call this as capex requirement. Now try to visualize these businesses. The businesses which require a massive amount of capital in order to survive. Capital for survival. Yeah. What do I mean by this? Now there are sectors, there are industries, let's say aviation, manufacturing, infrastructure. These sectors they require a lot of capital. There's a lot of wear and tear. They're asset heavy. There is a lot of wear and tear taking place of that assets. And usually, if you have a heavy asset base, bulk of your assets, because of wear and tear or because of other things, they may require replacements. These replacements are often carried out through capital expenditures, capex. Yeah. Capex, by the way, you have two types of capex, and I'll be focusing on one of the two types. The first one is your maintenance capex, and the second one is your growth capex. This guy, the maintenance one, it's a mandatory. You cannot ignore this capex. And this mandatory capex involves a good amount of replacement in such asset heavy sectors. Yeah. So, which is why, you know, if your company has a very strong asset base which continuously requires you to pump in money such that the assets can continue to perform optimally, these reinvestments are mandatory for you. If you do not get these machines replaced, you will not be able to offer the products or services which you set your business up for. Then that's a challenge. Why? Because again, look at the definition, look at the full form, EBITDA. It is something which is done before DNA, depreciation, amortization. And many times, depreciation and amortization, as I said, they look at these replacement costs. Yeah. So ignoring EBITDA or ignoring those kind of replacement costs can lead to an unnatural view of the business. So EBITDA cannot be blindly trusted in this kind of situations. You need to have more metrics to understand the true story of the business. Yeah, this was the second scenario. Now let's look at the another scenario, the third one. Let's say the third one. This situation, this is where this is a scenario where EBITDA needs further investigation. You need more metrics, and the situation is that there are a lot of adjustments to your EBITDA. Your EBITDA is not a plain vanilla EBITDA coming to you straight away by deducting operating expenses. No, you see that your company is making a lot of adjustments. They're doing a lot of add backs. They have a lot of one time slash one offs appearing in their calculations. Yeah, that's something that needs to be scrutinized. For example, uh, there are restructuring expenditures which gets added back. Then there is stock based compensation. Yeah, there are one time gains, one time losses. Yeah, anything of the sort. This is not an exhaustive list, but you see a lot of such adjustments. See a lot of these things happening in your notes to accounts being talked about by the management in the notes to accounts. You see these things happening when you deep dive into your EBITDA. Now, what this does is this inflates your EBITDA. All these adjustments, they will inflate. They will make your EBITDA look bigger than it practically is. Yeah, thereby telling you that, okay, whatever is the situation, simply do not rely on EBITDA alone. Look for alternate metrics. Now, what could be these alternate metrics? The alternate metrics could be net income. The alternate metrics could be your cash flows. You have things called FCFF. Yeah, these metrics, they are difficult to be manipulated the way you can manipulate the EBITDA. Yeah, so all in all, a very easy topic, very easy concept to understand, but definitely gets tested when you are going for high profile interviews, specifically for investment banking and related job offers, where the multiples become relevant for certain sectors. You may look at EBITDA multiple for certain set of sectors. For other set of sectors, this multiple may require further scrutiny. So under those situations, you should be able to understand why do you need further analysis. Why do the things not stop at that level? And these are some of the reasons. These are some of the exceptional scenarios where EBITDA may not give you the complete story. You may require further deep dive to get a better picture. Yeah. So yeah, that's it for this video. I'll be coming up with more such educational content. So do like, subscribe this channel. This is Pratik signing off. Thank you so much.